Hello, my name is Adzrul Syafren from Group NBF4M. Today I'll be presenting my assignment one as part of the FIN 537 course Corporate Finance with the topic given Capital Structure. This presentation will cover the meaning of capital structure, how companies decide on the best financing mix, and the key theories and concepts that influence those decisions. So this discussion consists of eight subtopics. The first one is what is the capital structure? It is refers to the mix of long-term funding sources, mainly debt like bonds and loans, and equity, common stock, and retained earnings. These funds are used to support business operation, growth, and investment. It reflects how a company balance the pros and cons of borrowing versus raising money from shareholders. A smart capital structure can lower the cost of capital and increase company value. To maintain the right balance, companies may adjust their debt and equity through capital restructuring. This is important because capital structure affects financing costs, financial flexibility, and shareholder value. So the key factors influencing these decisions are uh, trade-off theory, balance tax benefit of debt with bankruptcy risks, pecking order theory, prefers internal funds before debt or equity, market timing theory, issues debt or equity based on market conditions, agency theory addresses conflict between managers and shareholders. Next, how to determine the optimal capital structure. So companies value and reduce its WACC, which is weighted average cost of capital. The best approach is to balance debt and equity. According to DWAT 2006, this can be achieved by using financial models that combine theory with a real-world data. The main idea is that it's cheaper due to tax deductible interest, but too much debt increase the risk. So equity cost is calculated using CAPM, adjusting for leverage using Hamada's formula. WACC is the average cost of capital from debt and equity. A firm value equals to net operating profit after tax divided by WACC. The optimal capital structure is where WACC is lowest and firm value is highest. The key concept is WACC used to value future cash flow. Lower WACC equals to higher firm value. Too much debt causes financial distress, reducing value. So this is the step to find the optimal capital structure. A is estimate cost of debt, B estimate cost of equity, CAPM, C is calculate the WACC, D estimate firm value, E identify optimal debt ratio. Next subtopic is factor affecting capital structure and capital structure decision. A company's size and profits are key internal factors in deciding how to raise money. Like larger, more profitable companies often use their own funds to save costs and keep control. This of asset company owns also matters. Companies with valuable physical asset like buildings or equipment can borrow more easily because they have collateral. Firm expecting fast growth may choose equity instead of debt to keep their financial flexibility and avoid regular loans payment. If stock price are high, company may issue share. If interest rate are low, loans become cheaper, making debt more attractive. Tax laws matters because interest on debt is tax deductible, which makes borrowing less expensive than equity in many cases. So next is discussion of financial distress. Financial distress refers to situations where a company is struggling to meet its financial obligations. This includes paying suppliers, repaying loans, and covering day-to-day operating costs. It's often the first warning sign before more serious outcomes like insolvency or bankruptcy. Recognizing distress early is crucial so that corrective action can be taken before it's too late. Cause of financial distress. There are both internal and external causes of financial distress. Internally, poor cash flow management is a major issue. When a company spends more than it earns, it can keep up with expenses. Over reliance on borrowed funds, also called high leverage, increases risk, especially if revenues fall. Externally, market shocks such as economic recession, inflation, or global events like pandemics can severely affect sales, supply chains, and overall stability. Other causes include poor budgeting, overstocking, or delays in collecting receivable. Warning sign of financial distress. These are the several early warning signs to watch for. Example, consistently missing loan or bills payment is a clear signal. Some companies take on more debt just to repay existing debt. This is dangerous and unsustainable. Difficulty in raising funds, shrinking working capital, or getting negative remark from auditors are all indicators that the business is in trouble. The sooner these signs are identified, the better the chance of recovery. So the consequences, the effect of financial distress can be severe and long-lasting. First, lenders and investors see the company as risky and will demand higher interest rates or stricter the conditions, which raises the cost of capital. Secondly, the company's reputations suffer. The supplier might demand upfront payments, customer might lose trust, and business partners may back away. Third, stakeholders like employees, shareholders, and creditors lose confidence. Employees may leave, investor might sell off shares, and lenders may cut off funding. Finally, when access to credit is restricted, companies struggle to maintain operations, let alone to grow. Next discussion is on financial distress. Leverage refers to using borrowed money to finance operations or investment. When used wisely, it can boost profit. But if a company borrows too much, especially without steady income, it increases the risk of distress. Managing leverage means borrowing within safe limits, preparing for unexpected downturn, and stress testing financial plans. It's also important to maintain healthy cash flow and keep some reserve for emergency. Conservative capital structure are safer, especially for business in volatile industries. So the solution is when a company is already in financial distress, several strategies can help. First, renegotiating existing debt and reduce interest or extend repayment terms. Second, cutting the unnecessary costs. Third, selling idle or non-core assets to raise quick cash. Companies can also consider issuing shares to get fresh capital. Finally, it often smart to bring in financial consultant or advisors to help restructure the business and develop a turnaround plan. The key is to act early and decisively. So next, the integrations of tax effects and financial distress costs. In this slide, we look at how the use of debt impacts on a company's value. One of the main benefits of debt is the tax shield. Since interest payments on debt are tax deductible, they reduce the company's taxable income, which in turn lowers taxes and increases the firm value. However, as the company continues to grow more, the risk of financial distress rises. This includes both direct costs such as legal and administrative fees if the company faces bankruptcy, and indirect costs like damage to reputations and loss of trust from stakeholders. It is important to understand that while that can be beneficial up to a point, beyond that, it starts to hurt the company's performance and value. And then in this slide also explain the core idea behind the trade-off theory introduced by Myers. The theory suggests that firm balance the benefit of debt, mainly the tax shield against the potential cost of financial distress and agency problem. Initially, adding debt increases firm value, but at a certain level, the cost of carrying too much debt become too high. This include agency costs, conflict between management and shareholders or creditors, as well as the increasing risk of default. The firm goal, according to this theory, is to find the sweet spot where the marginal benefits of debt exactly equals to the marginal cost. That's what we call the optimal capital structure. So here we visualize the trade-off theory using a simple graph. Next is agency cost of equity. Let's begin by understanding what agency cost of equity are. These costs arise due to conflict of interest between shareholders who own the company and managers who run it. Since managers don't always have the same goals as shareholders, they may pursue personal agendas like expanding the business for prestige, enjoying lavish perks, or making decisions that prioritize short-term gains over long-term success. This action don't necessarily create shareholders' value and can lead to inefficiencies, which ultimately raises the cost of equity. So types of agency cost. First, we have monitoring costs, which are expenses shareholders incur to keep uh, an eye on management. These include things like audits or hiring internal board members. Second, bonding costs are borne by the managers themselves to show commitment to shareholders. These signing contracts that limit risky behavior or tie compensation to company performance. Third, there's residual loss, which represent the value lost from conflicts that remain even after all efforts to monitor or bond. These costs are harder to eliminate completely. The impact on firm is weaken the company financial health. Misaligned interests can lead to poor decision, make reducing efficiency and profitability. Investors may view the firm as a higher risk and demand greater returns. Pushing up the cost of equity, if the market consistently see governance issues, the firm might even become undervalued, affecting shareholders' wealthy negatively. Fortunately, there are effective ways to reduce this cost. One of the most important is strong corporate governance. This includes having a well-structured board of directors that actively oversees management. Protecting shareholders' interests, transparency is a key. Regular and honest reporting builds trust. Lastly, aligning executive incentive with company performance, such as offering stock options or performance-based bonuses, ensures the managers benefit when shareholders do, creating a win-win scenario. So next is pecking order theory. The pecking order theory was introduced by Myers and Maljuv in 1984, unlike the trade-off theory, which assumed companies aim for an optimal capital structure. Uh, it's explained that the firm follow a financial hierarchy. This hierarchy is based on minimizing costs, especially those arising from information asymmetry between managers and outside investors. The central idea is that the firm prefer internal financing first, followed by debt, and only issue equity as a last resort. The core concept of information asymmetry behind this POT is information asymmetry. Managers generally have better insights into the company's value and future than outside investor. When a firm issues equity, investor may perceive it as a sign that the company's share are overvalued. This creates a negative reaction in the market, known as an adverse selection, which can reduce the stock price. To avoid this, companies prefer financing that doesn't trigger such market skepticism. Internal financing, especially retained earnings, is always the first choice. It allows companies to fund growth without involving in external parties. There's no need to disclose sensitive information, no dilutations of ownerships, and no fixed repayment obligations. It's also send a strong positive signal to investor that the company is generating enough profit to reinvest in itself. Many firms build cash reserve to ensure they have enough internal fund for future opportunities or downturns. So when internal funds are not enough, company turn the debt. Debt is preferred over equity for several reasons. It doesn't dilute ownership, involve fewer disclosure requirements, and interest payments are tax deductible, which creates a tax shield. However, taking on too much debt increases the risk of financial distress, especially during economic downturn. So firm use it cautiously, and the decision often depends on the company's stability and cash flow predictability. Equity financing is the least preferred option due to several drawbacks. It can be interpreted by the market as a sign that the company's share are overvalued. It dilutes ownership, which might not sit well with existing shareholders or management. Equity issuance also involve more regulations, higher costs, and longer timelines. Company only use this method when all other options are exhausted, usually during financial crisis, rapid growth phases, or major strategic changes. Lastly, is signaling hypothesis. Signaling hypothesis in corporate finance. In This theory focus on how a company's financial decisions send meaningful signals to the market, especially when there's information asymmetry, meaning managers know more about the company's true value than outside investor. For example, when a company issues new stock, it might be signaling to investor that management thinks the shares are overpriced. This often causes the share price to drop. On the flip side, if the company buys back share or uses internal funds or debt to finance project, it usually signal confidence in the company future and that it might be undervalued. This idea was first introduced by Ross in 1977. It's based on the assumptions that managers whose personal income or reputation depends on the company's success have a strong incentive to communicate honestly. So this is the real example of signaling is when a company raises its dividends, which many sees as a sign of expected future earning growth. However, it's important to note that not all signals are accurate or risk-free. Weak or misleading signals can backfire, especially if the company future performance doesn't live up to expectation. Overall, signaling hypothesis shows us the financial decisions are not just about raising funds, they also serve a communication tools that influence investor perceptions and the market value. This concept ties closely with the pecking order theory, POT, which also highlights how internal parties interpret a company's financial financing move, especially when information is limited. So, thank you. That's all from me.